Let's talk about our good friends at Berkshire Hathaway. Matthew Palazzoli, he joins us here from Bloomberg Intelligence. He covers all the insurance companies, including Berkshire Hathaway. Berkshire Hathaway in the market again here for a deal. What is Taylor Morrison, and what does somebody as a Berkshire shareholder think about this deal?
So you may or may not recall, I was in here a couple of weeks ago, and I had said what I would like to see Greg Abel do is hit some doubles and singles, perhaps. Okay. I think this is exactly in line with that. So Taylor's a home builder. Berkshire owns the biggest off-site home builder in the country.
What does off-site home builder mean?
So they build the house, and then they bring you the house. So when I was at the annual meeting in May, they literally had houses inside of the convention center. And those houses are more on the affordable end. This is a vertically integrated company. They're a company they own, Clayton. So they do it from beginning to end. They sell the house. The houses are maybe around $200,000. This company they're buying fits very nicely with it because they're an on-site builder of more higher-end homes. So it's complementary to the business that they have. They're not paying too much. It's $8.5 billion. That's about 2% of their $373 billion cash as of March 31st. And the valuation, these stocks have been beat up, as you might have guessed. So the valuation's down. I think I'm not a home builder analyst, but Taylor was underperforming peers, and I don't think Berkshire minds that all that much to get it at probably a discount to its historical valuation.
And one thing that analysts point out is the fact that Greg Abel said that they want to, over time, unify our site-built home building operations into a combined platform with this new purchase of Taylor Morrison and combine it with Clayton Homes. This is a different strategy, isn't it, from Berkshire's usual approach of letting acquisitions run on their own under their own branding?
Yeah, no, that's a good thing to point out, Scarlett. They typically, Berkshire does not ever talk about synergies or use that as any kind of justification for ever buying something. But Greg Abel did specifically note, so Clayton, they do the business where they build a house and they bring you. They have a smaller business where they do build it on the site. And they were building that, pun intended, over time, through acquisitions. So what Abel's saying is we're going to take that business and probably fold it into the Taylor business, and it's probably a better run through them. Also, by the way, Berkshire owns a ton of manufacturing component businesses. So Paul, you probably have the Benjamin Moore Seafoam paint in your shore house.
You bet.
That's a Berkshire Hathaway product, right? They do flooring, insulation. There's all kinds of companies. And again, they don't talk about like having synergies here, but there's definitely some opportunity to.
So they control a lot of the supply chain.
Yeah, and Taylor, while Clayton is vertically integrated, Taylor buys from suppliers.
What's the cadence of acquisition activity for Berkshire Hathaway? Do they like to do one a year, two a year, one? Just opportunistic? You know
the answer to that, Paul. They're going to do it when they see it in the market. They don't. There's no timetable. There's no. We have to do it. We have to deploy cash in any way. They preach patience over anything. So I think it's when we see the deal, we do it. In the note we put out today, we do have the deals and capital deployment that they have done over time, and it is, I think, more than you'd realize. Yeah. They spent $12 billion on Google stock in the first quarter, which is bigger than this acquisition.
We look at Berkshire Hathaway shares, and they've kind of underperformed, down 5.6% this year when the S&P is up about 11%. Does this kind of deal help Berkshire make up some of that gap?
Probably not. I don't think so. I think this is probably Abel building investor confidence over time. I mean, I think that the leaving of Warren Buffett really left a hole in the hearts and minds of people investing in the company, and I think that needs to be rebuilt. I think, ironically, Berkshire's the kind of proto anti-AI trade. They have all the hard assets. They have the financial business and the insurance. Should you see the AI trade kind of sell off, it would be the natural company that I would think would benefit from that. But even in the times where that has happened earlier in the year, it hasn't really overperformed.
Because there's been, we'll let you go, but there's been plenty of times to invest privately in these big tech companies, and they haven't done it.
Yeah, no, I mean, we talked about it. They bought into Google, which is becoming obviously more and more of an AI play. I think that will happen over time, but I don't think you're going to see them doing those kind of smaller tech deals.
You think about it, there's so much capital or demand for capital and they're sitting on a bunch of it. You could put the two together. Matthew Palazzolo, senior analyst covering the insurance business. That means he covers Berkshire Hathaway for Bloomberg Intelligence. He goes out to Omaha with the rest of those folks.